Good morning, everyone. I'm Dan Hussey with Zaner Ag Hedge, bringing you a strategy of the day update here for a little pre-WASDE update on March 8th, 2023. Remember, trading futures involves risk and is not suitable for all investors, and everything we talk about here today is just my own opinion and not a direct trade recommendation. But we would love to talk with you more. In fact, invite you to join us later today at 2 p.m. Central for our Zaner Ag WASDE report recap webinar. They'll be held again at 2 p.m. Central. Check out the sign-up links in the information and comment section of this video, but also do check out that webinar we're hosting later today. Sign-ups, of course, will be able to attend the webinar, ask questions, and receive a recording of it later if you can't be there live. So if you can't be there live, sign up so that we can get a recording to you, and you can have all the comments from our team on today's WASDE report. Speaking of which, U.S. ending stocks looking to come in with some meager changes. The biggest change would be in terms of expectations to corn, coming in at 1.3 billion bushels, just above that 1.3 billion bushel mark. Trade range from 1.28 to 1.36. So all within margins of error when you look at the bigger picture on some of these numbers. But still, we're arguing right about some small changes in the U.S. balance sheet, which really isn't the focus of this report. Soybeans coming in with a trade expectation of 220 million bushels. The trade expecting between 200 and 250. That's down 5 million bushels from February's report. And wheat coming in 5 million above February's report at 573 million bushels. Expectations between the 550 and 600 mark there. Again, all kind of negligible in terms of how many bushels we're arguing over in the ending stock number, because we've seen revisions in the past that are far bigger than this. In other words, all these numbers seem to be within a margin of statistical error. And to me, not the focus point for a U.S. ending stock number. I think those are fairly well beaten numbers at this point. World ending stocks, however, do seem to be a driving factor here. Corn expectations for 2 million metric tons less at 293.17, down from 295 in February. Soybeans down 2 million metric tons, mostly due to Argentinian production, as well as potentially for corn here, maybe a little bit of a late Brazilian plant to go on for the second crop. But wheat coming in pretty unchanged, but at 269.4 compared to 269.34. Once you dive down into the balance sheets a little further, you see that the changes being made to Argentinian soybean and corn production are driving some of that balance sheet reduction as well. So that's really where the focus is. Watch for that 36 handle, that 36 million metric ton number from Argentina from trade expectations. I think there's an argument to be had in today's report over whether or not that's priced in. If we see a lower than 36 number here, will that spark some bullish price action and reaction from soybeans? I don't know, but that would be the trade's indication for now. But I certainly don't think anyone's anticipating the USDA coming in with anywhere near that 41 million metric ton February number, and I think that would be a big surprise on this report. Corn for Argentinian production coming in at 47 million there in February's report. Trade expectations for 43. So yet, another substantial cut there on the balance sheet in terms of expectations. It's the big changer here. All eyes on what the USDA is going to say about Argentinian production on today's report in just a half an hour's time now. So let's go over the charts and take a look at where May corn, to begin things off here, is trading 634 last, unchanged on the day. The last few days of price action could be, discussed as, maybe a little bit of a reversal, getting some legs and trying to get momentum off of lows, but ultimately, resulting in what now just looks like a dead cat bounce for May corn. 18-day moving average still above us at 656. I could make a case for price action, on a bullish number today. Let's say the USDA comes in and says, 43 or 42 million metric tons for Argentinian corn or something. I don't know, surprises the market, right? Look for that, 656 area, that 18-day moving average would be short-term resistance. Nevertheless, on a way move back up, ever since we broke below it, we really haven't had a solid test of it as resistance now. And if corn's going to begin a downtrend, we would expect that ATD to come in here and wallop the market lower, on if we're rolling over. I do not like how May corn has continued to consolidate below that December 6th and the lows for December there. The market has broken below multi-month lows, and we're staying below those figures. That's not a bullish development as of late. But one can say that the market pulled back into supportive area, right? The 640, 620 area. It's old support where we launched from in August and September. It's support from December. It's a front run of that big gap fill down at $6. It's the levels that need to hold. Otherwise, we're going to a gap fill at $6. Bull markets don't fill gaps. And if we're filling that $6 gap, why would we stop at $6 in my humble opinion? This market, I think, would open up to the downside, and we would be flushing out, towards that 550 figure, kind of the launch pad from last January. And when I say last January, I do mean January 2022, where the rally in May corn really began altogether. So we would be unwinding this entire, what arguably could be said is was the inflationary move in row crops, right? We've already seen wheat unwind most of its move due to headlines from Russia and the Ukrainian conflict abating, or becoming, maybe worn out, so to speak, on their effect on the market. But I do think we are into a supportive area on corn that more or less needs to hold. Not to say that we will, be entering a long, protracted bear market that would take us down below $5 and a $4 corn. No. But flushing out those lows would give us a reason to capitulate. It would find that demand for corn, I think, in this environment, in this economy, that might be lacking at current prices, or at least the demand is lacking to, sustain a rally in price, right? I think one could make an argument over the last year, almost year now, for the price action of corn and soybeans. Supply and demand have been relatively equal because we just keep coming back to the same prices. Somewhere around the $15 handle for soybeans and somewhere around $6.50 for corn, have been a reversion to the mean that has been trading for months on end, right? But if we have a wall of production coming down the pipeline out of South America, second crop finishes strong, good planting in the U.S., good weather through next July and into August, there's a really good case for how we've made a substantial top, in the market until we have those bull cycle, dynamics going. Russia and Ukraine shake hands and find peace. If we have all these other things that could happen, right? Just as much as a big drought year could happen this year, right? We could have a flush production year, all things being equal and considered, just as much as you could have a crop, or a bad production year, right? More times than not, though, statistically speaking, we're setting new trend yield, right? And production's improving. So at some point, we have to imagine that the tight balance sheets that we see on a WASDE report like today will get abated. And one place that I'm focusing to see if that is, being priced into the market is an old crop, new crop spreads for this year. We have very inverted markets, particularly in soybean, new crop, old crop. I don't have much to say on the corn daily chart. Let's get into these old crop, new crop spreads in a second. Let's just wrap the daily chart for corn. All of our moving averages are clustered above us, up around the 660, 665 area, the 55-day, 100-day, and 200-day moving average. I almost want to see a rally back up to those levels to get rejected again, to roll over, to confirm more of a downside move. And at this point, I believe above the 620 area in the near term, it's just a short-term line in the sand in a defense from the bulls that we found some support that hasn't been able to be cracked. Today's news event, though, could be something, right, that does it. If today is not as bullish as the trade expects, or beats those bullish expectations, we're really running out, right, of a bull narrative to feed the market to keep prices sustained. And that's why we've fallen back, I think, like we have, off of the 680 figure. It took how long, right, to try to break above 680 for May corn? It couldn't do it. So now we had to go find support. We took the stairs up and an escalator down, as futures markets often do, particularly at this time of year. But the way balance sheets still look, one has to still come at these markets with the perspective that, hey, how far down do we need to travel before we find demand again, right? Because I think at these prices, they're I don't want to say there's necessarily demand destruction going on domestically, but certainly internationally, we're seeing, right, traders' eyes turn towards other stockpiles, like in South America, to meet their demand, particularly with the rising U.S. dollar and high prices of commodities in the U.S. It makes sourcing those commodities cheaper elsewhere. All right, so daily chart of corn. There's, I think, room to the upside for this market to go. I'm expecting the 620 lows of today to generally hold the support, and for more today to be more of maybe a short covering rally, just because of how we moved into this report, how we're trading at the start of the month, and what have you. But I do think whatever resistance we find, if it doesn't crack and if we roll back over, we do have some lines in the sand, so to speak, to watch on both sides of the market. 620 to the downside to remain. I don't want to say just a bull, but if we break below 620, as I alluded to before, what stops us from filling the gap at $6? What stops us from trading to the lows of August? It just feels a lot like this market has a lot more flushing out to do. And, my bear hat has to be hung up on the sideline then, right? You can still cling to hoping the market could find a rally back into the old range today. News event like today could push us into it, but I'm not one to sit here and bet on that type of news if I'm not already positioned. Let's put it that way as well. Soybeans, a lot choppier for rally that we've seen. We're fighting over some of our moving averages there. But like I alluded to earlier, I'm really watching some of our calendar spreads, particularly the soybean complex. July Nove beans trading at $1.34 3/4 over. That is up 3.5 cents in the day. Finding that 55-day moving average at around 122 a few days ago as support. Crawling back above that 18-day moving average now. Trading these levels actually very technically. And staying above and flirting with this 18-day moving average right around here, around 133, seems to be the fight over the trend that we're witnessing, right? A pullback towards a dollar over or even towards 50 cents over doesn't necessarily mean that we are completely unwinding the inversion. We're going to go into more bearish conditions. We're going to be building carrying to the markets, but I do think that for March 8th, being $1.34 over is incredibly inverted and very tight and very wide in a spread where there's still a lot of unanswered questions about production this year, right? And the current currency situation and current demand situation may not justify or warrant a need to bid up near-term soybeans to this extent, because where's the fear that we're going to run out, right? If we're fearful that demand is going to be, not tolerated at these levels, and that, right, the dollar rallying might help diminish some of that. In other words, the spread has run its course. It had a great uptrend through January. Now it looks like we're in consolidation and maybe even, starting to build some carry back into the market. If we believe that a good production year or a good planting season is around the corner, if we think the spread needs to wind back, I think it's at levels to start to consider bear spreading. I would do so with finite risk, though. I think above $1.50 over, you got to think again how this can open up to $2 and $3 over. But while we're below $1.50 over in the short term, that's just the highs from February 10th at this point. And certainly, if we can get back below that 18-day moving average, I believe the July Nove spread in soybeans could be rolling over. It could be a canary in the coal mine here, warning for a period of volatility or generally range trading and outright futures. Which when we take a look at just a May futures contract for soybeans, July doesn't look that much different. Which is why I'm just looking at May, right, our front month. This has been a very choppy trend, and it's hard to even call it a trend because it's so overlapping. It feels like since August we've been consolidating higher in soybeans, which to me means we may need a much bigger pullback and a move down, towards $14 in the near term. We shall see. And that's just because that's the range we've been in, right? I'm not pulling 14 just randomly out of a hat saying I'm bearish and I want us to go to that level. That was the level back in October we launched from and began this last leg up. Below there's $13. We're struggling, in my opinion, to stay above 15. Arguably, we're struggling to break back below it, though, with the last 3 days of price action. But Like corn at 680, how many times do beans need to try to break out of 1540 and fail before they really have a flush out? And I don't mean like 60 cents off of highs that we've traded basically 4 times since December. No, not the range trade that we've been in. That's not what I'm referring to. I mean like the sell-off we saw from last June, or even a sell-off from September, $1 or more in soybeans. Unwind, several months of price action, not just the range we've been in between 1480 and 1540. The 60 cents that has been lulling a lot of us, traders to sleep, in a trend that is unfortunately losing momentum and diverging. 100-day moving average was supportive down there around the 1480 area, 200-day down around 1460. Yeah, it's a range until it's not. 1480 to 1540. We've had 3 solid tests of support. We've had probably 5, maybe 6, depending on how you count that, test of resistance. We could test down to 1480 today on the news. We could break out of 1540. But I believe we're in a range until we're not. And I am fearful that we are in a period, trying to test support more so, or find that support more so than resistance. Beans have been a little bit of an odd man out the last few days, but again, it seems to me that with a 200 bushel carryout, it's really tough for soybeans to sell off, and I think it's going to be tough for us. I think dips will continue to be bought until there's a reason. Which planting and acreage coming up into the end of this month could be another reason to shift that idea. But it seems to me that soybeans are very content trading both sides of the book for the time being without any. Again, it's hard to call this a trend because it is higher highs and higher lows in terms of the swings, but markets are not usually this overlapping and choppy. And that leads me to believe that the trend lines against the lows, when they finally do give way, they tend to be very, very, very volatile. And it's just a sign of when support gives way, right? A trend line is just one indication of support. And the reason being is that we've spent so much time bottlenecking up and unable to break out. There's only one place for this, love to go. All the longs that have built up in this whole move since August will need to get flushed out at some point. And I'm fearful that without a significant move above 1540, right, we're just setting ourselves up for that type of move here in the market. But nevertheless, you can't argue with the last 3 days or last week of price action being a swift recovery for soybeans off the 1480 low. But again, it's just right back up in the range we've been in, and there's not much else to say, going into a report like today. Last but not least, Chicago and KC wheat both flirting with their $7 for Chicago contract and the $8 for KC wheat handles. Those are big, I think, psychological supportive levels. Yesterday, we seemed to be putting in the type of day that could have sparked a reversal if we saw follow through to the upside and maybe even a low. Today was the type of day that negated that idea, made a new low, flushed out anyone who jumped in too early, ran the stop below the low. And while oversold in just about every indication you can look at in wheat, markets can remain very irrational longer than we can remain liquid. Below every single moving average there. Chicago wheat, 741, 18-day moving average, 55-day up at 756, with the 100-day up at 790. That's $1 away from its 100-day moving average right now. I think some reversion to the mean is in the works and some short covering for the wheat complex, but it just isn't showing any signs, right, of a reversal. Need to get through today's high and yesterday's high for me to feel confident in that, but maybe a move back above $8 here for the case of wheat and back above 7 for Chicago would make me a little bit more interested in trying to take some risk alongside, because I'm not willing to catch a falling knife, but I am willing to take an opportunity if a reversal proves itself. I just don't see it on the charts in the current short-term price action. Not like, back in some of these bounces where we had some reversal setups that happened on the daily chart. You get a rally for a few days, it reverses and gets unwound, but at least there's that reaction. I don't see the setup just yet, right? One day causing a long tail doesn't a reversal make, right? It's got to walk before you can crawl. So we'll see how the number comes out here in 10 minutes. Again, I think the focus will be on South America, on that South American production number. I think this is report that is going to be more of a soybean-driven report. I think price action of the last week or so has been markets having an arm wrestling match over trying to figure out where soybeans should be priced. And we've clearly had a 60 cents range going into and with that argument here this week. So have a great day, everybody. Join us later today at 2 p.m. Central for that all Zaner, WASDE webinar recap. Sign up links in the information and comment section of this video. Have a great day, everybody, and we will be back with you later today and as price action develops. Take care, everyone.